Hello, everyone, and welcome to another episode of my Market Talk series. Today, I would like to be giving my views on the recent US credit rating downgrade by Fitch. So, on the 1st of August, Fitch has cut the US credit rating by one notch from AAA to AA+. This sudden announcement has sent the US markets into a one-day shockwave, where the S&P lost as much as 7% in one day. So, how did all this happen? Let's take a look. So the US debt has already reached a point where the government has reached its borrowing limit, known as the debt ceiling, and the government can no longer borrow more money to pay its bills without the debt ceiling being raised. This led to the last downgrade by Fitch, that was in 2011, right after the global financial crisis, and now the current one on 1st of August. So, we know that Fitch has indeed downgraded the credit rating in the recent years by 2 times. But if you think backwards, okay, this is in the sense that the rating actually remains unchanged. Okay, and it's not a further downgrade because in 2011 the rating from AAA became AA plus, and then when you went back to AA again, now the current downgrade is back to AA plus. So this is not a further downgrade. Okay, the current downgrade is mainly due to the White House and Congress having disagreements on the best ways to raise the debt ceiling, and up until now is still unable to come up with a conclusive plan. The Republicans want to raise the debt ceiling in exchange for spending cuts, but the government of today, the Democrats, even though they too agree to a raise in the debt ceiling, does not want any strings attached to it. Fitch realized this uncertainty, and they felt that all this should be priced in by taking into account the risks and probabilities of a likely no pass-through of the debt ceiling bill. Therefore, the only one thing responsible for them to do is to downgrade the rating by one notch. This made the Democrats surprised by the sudden downgrade move, and Treasury Secretary Janet Yellen even spoke out against the downgrade, saying that it is purely arbitrary and that the downgrade is used to politicize the situation, and the data used by Fitch is not current to make the downgrade decision. However, what do I think of this rating downgrade by Fitch? Is it a cause for worry? Will it lead to another global financial recession? As markets was indeed spooked on the 1st of August, demonstrated by its large fall in overall share prices. Let's take a look. So let's first look at the US GDP from 2019 to 2023. You will notice a correction dip in the middle of 2020 to 2021. I believe this reflects the many COVID lockdowns in the US and muted spending during that period, leading to a dip during this period. Right after that, okay, there was a reopening. So we see that GDP growth has headed to new highs and currently even higher than the pre-COVID days, if you compare 2019 versus 2023. There was also a current year-on-year increase of 5.83%, and this clearly shows that spending remains strong up until today, 2023, this year. This is despite the many Fed rate adjustments since the reopening of the economy, with the original aim of dampening the inflation. So if you look at the CPI index, the consumer price index has indeed come down since its peak in 2023, right after the reopening of the economy. This was the period when the Fed started to make the many rate adjustments, and clearly it shows that the policy has been useful in balancing out inflation. Okay, we look at the S&P 500 index, and we realize also that most US Fortune 500 companies too have been announcing better than expected earnings up until today, amid hiring freezes and layoffs since the end of last year and all up until the beginning of this year. So a lot of cost cutting has been implemented by most Fortune 500 companies, and still we managed to see better than expected earning results. And With all this led to a major US indices move that hit record highs back into bullish territory from a low of 3,588 points somewhere around August last year. Right until today, it's currently at 4,788 points. Therefore, I think that the US economy as a whole is still robust, despite talks of a severe recession by some analysts due to hyperinflation and the current debt issue. However, if we looked at the US Treasury surplus and deficit index, we realize that the Treasury is currently on a deficit. This requires the government to borrow and pay off the deficits. With the debt ceiling almost reaching its ceiling cap, the debt ceiling issue is now watched very closely by the market participants and the government. This to me is a cause of concern, as it is said that it is currently now a Congress issue and not so much of a market issue. So the rating downgrade coupled with the uncertainty of the debt ceiling have caused US Treasury yields to go up as investors move to shorter term treasuries due to a flight of safety. The longer term 10-year yield security prices will definitely worsen. And the US dollar have also seen strengthen against most major currencies as investors move to buy the dollar in hopes of higher interest and safety rather than investing into equities this period. In conclusion, I think most large businesses in the US have also ensured that the lessons learned from the 2009 global financial crisis should not be repeated. In fact, the Fed has come up with a new bill to be passed that will further increase the bank's Tier 1 capital ratio. And this is made to further protect US consumers from another bank run, where the situation is similar to the Silicon Valley Bank closure. Therefore, as a whole, I think businesses and the government is more aware of another likely serious crisis happening and will not let their guard down now. But based on the data I presented to you guys today, in my personal opinion, alright, I think that the US economy seems to be on the right track. Even though valuation is currently a little higher compared to last year, this has been due to over bullish sentiments that a hard landing crisis can be avoided. I always mention in my company health check series videos previously, okay, if you haven't watched it, do watch them, and of course remember to subscribe if you like what you watched so far. That most valuations have already priced in all the positives and should correct itself. But so far, based on what I see, nothing suggests a hard landing crisis as of yet, as the Fed and government is working really hard to ensure early intervention is done to avoid another systemic crisis. I think that a deal could be concluded soon among the Democrats and Republicans, as continued uncertainty and the downgrade have been a signal already for the White House to move conclusively. Markets, even though it made a knee-jerk reaction on August 1, the markets since then have recovered and is definitely comparatively better than the one in 2011, the last downgrade. This shows that investors are confident that the government of today and the preparedness of the US economy as a whole is more fundamentally resilient as compared to the 2009 financial crisis. But again, despite better than expected earnings for most companies in the current quarter, many managements have signaled lower and slower growth in the months ahead, and investors will therefore be more cautious and a sell down should happen. But it is an important lesson that as a value investor, our main job is to ensure that the long-term fundamentals of the business still remains intact and has to add value to mankind instead in the long run. We should not be too concerned about the economy in what the short-term predictions are, and we must not attempt to try to predict what the Fed and the government will do. Just focus on the business we buy. Instead, any corrections in the market will give us value investors an opportunity to hunt for good deals again. The key here is whether we are ready when the market turns against us. Most people would have used up all their bullets during the bull market by trying for short-term gains. In fact, some might even take on leverage during a bull market. I have to admit that most people really do make money in a bullish market, where any stock you buy, it's very easy to make money. And this makes it very tempting to take action too. But I always remind myself that my strategy is to avoid taking on leverage during a bull market and avoid getting my hands itchy on the attractive short-term gains. Instead, focus on accumulating as much bullets as possible and increase my war chest during these bullish periods. Take little or no action in bullish times, which some of you may feel a bit boring, right? But to be a good value investor, attitude and mentality really counts, and strike when the winter does come. So with that, I'll wish you guys all the best. Have a great day ahead. Okay, and remember, for the win, all right? Hope you guys make money when the correction comes. Let's keep ourselves updated. See you guys